Thomas, maybe for the audience that doesn't know about the low float, high FTV, but could you unpack that a little bit about where we are right now and why the unlocking schedule is so important?
Having an IPO and they only float 1% of the stock or something like that. And it's, a lot of people want to own this stock, and there's a lot of assets and not much potential freely floated out there. That might cause it to go up, and sort of the early venture investors, they might hold a lot of the sort of private tokens that unlock over time on a vesting schedule. It might be a 3-year vesting schedule. And so, that 1% float might suddenly go to 50% float in a year or something. And can the market absorb, kind of a very high market cap, a lot of tokens being dumped on the market in the course of a year or 2 years. And a firm maybe that needs to sort of show DPI to their investors. So they might love the project, but sort of feel obligated to sell it. And I think that creates some sort of dynamics where you don't really know if these public token prices are super real or inflated by the fact that they have a low float.
And this is obviously one of the other metrics that all the fundamental investors I follow are tracking. They're tracking the token unlock schedules and trying to understand the implications for another 5% of the float being absorbed by the market.
Exactly, and that's why I was saying we might go back to a time where you actually sort of float a huge percentage all at once, and so you don't have this sort of psychological overhang to the market that, oh, there's going to be these unlock schedules. Can the market absorb it? But rather, okay, this is when all the tokens unlock. They all unlock together. Who's going to hold it from the VC class? Who's going to buy it from sort of the public investors who are looking at the opportunity on that basis?